The fastest growing fund in the history of traditional finance isn't a tech stock or gold. It's BlackRock's iShares Bitcoin Trust, or IBIT. This single ETF pulled in over $40 billion in assets under management in just 211 days. This racing bar chart shows the scale of that adoption. While the previous record holder took 1,253 days to reach that milestone, the Bitcoin ETF crossed the same line in less than a year. But while headlines focus on institutional adoption and the security of a regulated era, the market effectively splits. On one side are the transparent flows of Wall Street. On the other lies a landscape that functions very differently for the average retail trader. This is the dual nature of the American crypto market. It is an environment where sophisticated players use regulated financial plumbing to secure reliable gains, while individual investors navigate a territory defined by automated tax reporting and targeted cyber fraud. To understand how the institutional side functions, we have to look at the financial plumbing. Large hedge funds aren't day trading on retail apps. They exploit price gaps between spot ETFs and the $18 billion futures market, utilizing a low-risk strategy called cash and carry arbitrage. They also leverage regulated protocol staking. This diagram breaks down the specific yield for Ethereum. By taking the protocol's 2.68% base yield and applying a 70% staking ratio, leaving 30% liquid for daily investor redemptions, funds generate a clean net yield between 1.9 and 2.2%. While 2% might seem modest, it outpaces traditional conservative assets. As the chart shows, it sits well above standard gold lending programs, which currently yield less than 1%. By routing capital through these regulated instruments, Wall Street removes the volatility typically associated with crypto. They have turned the market into a sterile extraction mechanism, using tools everyday investors cannot access. But for the retail trader, the first challenge is navigating the government's regulatory dragnet. Currently, agencies like the CFTC and the SEC are locked in a jurisdictional turf war over whether your digital assets are officially classified as securities or commodities. Regardless of that classification, the IRS strictly treats cryptocurrency as property. This means every single time you swap Bitcoin for Ethereum or use it to buy a laptop, you trigger a taxable capital gains event that must be reported. The rollout of the new Form 1099-DA removes the possibility of remaining anonymous. Centralized exchanges are now legally required to automatically report your complete transaction history and cost basis directly to the government. The system is now structured to ensure the government extracts its cut from every move a retail investor makes. While taxation is a known cost, the bigger threat is the staggering $1.8 billion lost by Americans to crypto-related cyber fraud in a single year. The most psychologically damaging method is pig butchering. As this flowchart shows, it begins with an accidental text to build emotional trust. The victim is guided to a fake platform and even allowed a small withdrawal early on. But once they deposit their life savings, the account is frozen behind fake release fees and the scammer disappears. There is also a physical layer to these scams. Fraudsters impersonate government agencies to terrorize seniors over the phone, directing them to withdraw cash and drive to kiosks like this Bitcoin ATM. The victim then deposits the physical money directly into the scammer's wallet via a QR code. Victims of these crimes are often targeted again by recovery scams. Fake online companies charge upfront fees, promising to hack the blockchain and return the money, a claim that is technically impossible for any private company to fulfill. While institutions operate with fortress-like security and guaranteed yields, retail investors are systematically hunted by predators exploiting both human psychology and blockchain technology. These scams are effective because of the technical nature of the blockchain, absolute finality. Once a block is added, the transaction is permanent. Unlike a credit card payment, a bank cannot reverse the transfer. Survival in this market requires following strict security protocols. First, always use official CFTC background check tools to verify any platform. Second, keep long-term holdings in an offline, multi-signature hardware wallet rather than on an exchange. Third, and most importantly, any unsolicited financial advice online, regardless of the relationship, must be ignored. If you are victimized, you must act with extreme speed. Immediately file a detailed complaint with the FBI's Internet Crime Complaint Center. To have any chance of freezing stolen funds before they are laundered, law enforcement needs the 3 data points on this checklist: your public address, the scammer's receiving address, and the precise transaction hash for the transfer. The U.S. market provides infrastructure for rapid capital movement and yields that outstrip traditional gold lending. But these tools only benefit those who know the technical rules, move with caution, and maintain total control over their own security.